good evening and welcome to Economics Unbound. My name is Nzinga Kundam, standing in for Tandega Kubulembeki. Tonight we'll be talking about European Union trade and investment in South Africa. So South Africa offers many attractive assets for foreign investors, such as our diversified and advanced economy, our abundance of natural resources and well-developed infrastructure. Unfortunately, investors sometimes remain concerned about the lack of clarity concerning some policy and structural reforms, such as the broad-based Black Economic Empowerment Policy, which is the South African government's key instrument in reconstruction and development.
It's good to see you again on Economics Unbound. It's really a great initiative for South Africa to have foreign investors to make our economy grow. Zings, you know better actually, so please educate me and the viewers at home on the significance of having foreign investors in the economy. Well, according to my understanding, the EU is the largest source of foreign direct investment to South Africa. It has funded a study looking into the impact of local content requirements on EU businesses operating in South Africa. And the results make for interesting reading. According to these companies, local content requirements vastly increase the cost of doing business, with most of these costs passed on to South African consumers.
That's true. And another requirement for companies, including foreign businesses in South Africa, to source local parts has had mixed results, leading to some skills development and technology transfer, but also higher costs for South African consumers. Now, the European Union is South Africa's largest trading partner and the biggest source of foreign direct investment for the country. There are over 1,000 EU companies active in South Africa, the most of any foreign entity, according to independent research organization Who Owns Whom.
EU companies interviewed in the framework of a survey on the impact of local content requirements indicated that they appreciated South Africa's industrial and transformation policy imperatives and are committed to supporting skills development and technology transfer, which enhances the domestic knowledge and skills base. In some cases, this has led to the adaptation of foreign technology in the local market and helped increase South Africa's exports to sub-Saharan Africa.
So those companies that Nana are talking about have, however, raised concerns about design and implementation of local content regulations in South Africa, pointing out that these were at times inconsistently applied and in some cases unclear. Some local content requirements were also found to be unobtainable.
In addition, the survey of 14 EU companies operating across several sectors in South Africa found that the preconditions for an effective localization program do not exist in many sectors. As a result, EU firms have experienced problems in accessing the full range of manufactured inputs and products at internationally competitive prices in the local market. Small and especially family-owned European companies find it difficult to comply with the ownership element of South Africa's BBBEE policy, sometimes leading them to sell their goods through South African agents, further raising prices for consumers.
Right, so that survey also found that local content requirements have increased the cost of production, as we've just spoken about a little bit earlier on, in South Africa's very successful renewable energy public procurement program by at least 10%, most of which was passed on to the consumer. That's also increased the cost of production in other sectors such as manufacturing, but the impact there was difficult to quantify.
The study noted that the South African government was looking to extend and tighten local content regulations, given the loss in domestic capacity that has occurred in recent years. This may lead to a further escalation in prices in some sectors, benefiting entrenched manufacturers while undermining exports and South Africa's long-term international competitiveness.
Right, so let's just take an overview of European Union and South Africa relations. So from the beginning of the post-apartheid era, or the democratic era, the South African government was keen to formalize its relationship with the European Union. In 1995, the EU was South Africa's biggest trade partner and the most significant source of foreign investment. The importance of South Africa to the EU is, of course, much more limited. In 2002, South Africa accounted for just 1.6% of EU imports and 1.3% of its total exports. The relationship with the EU is significant and defines the integration of South Africa into the global economy. So this chapter locates EU-South Africa relations within a critical understanding of South Africa's domestic political economy. In doing so, it argues that South Africa has prioritized a neoliberal approach to integration within the global economy over the developmental needs of the poor black majority. So let's discuss the impact of local content policies on EU exports and investments, as well as economic transformation in South Africa. I'm joined by Laurelyn Kaziboni, who's an economist at DNA Economics. Thanks so much for your time on SABC News this evening. So you've done this report on the impact of local content policies on EU exports. Just tell us how you went about doing the study, how many people you surveyed, and what was the main points that came out of that?
Good evening, Zinga. So it's important to note that I co-authored the paper with Dr. Matthew Stern. We are both independent researchers that are interested in understanding bilateral trade and investment flows. What we did want to do was to understand how these local content policies have affected, the cost of producing goods and services in the country. And what we did was we designed a survey that we rolled out to 14 businesses in South Africa that are EU companies, which employ close to 1,000 employees. And during the survey, we looked at the strategies that the companies have adopted to meet these local content requirements, such as setting up manufacturing plants, local assembly units, or even, entering into partnerships with local South African companies. And from there, we're able to isolate the costs that the firms incur over and above, the standard costs associated with setting up brown and green investments. And from this process, the main takeaway points, which is what you have, already touched on, is that it has contributed towards increasing investment and exports. It has indeed met government's expectations around job creation. And especially, it's important to note that, these are highly skilled jobs in sophisticated sectors such as transport, renewable energy, and equipment sectors. But also, as you highlighted, it has indeed come at a cost.
So what's the attitude of EU companies that you've interacted with in that survey with regards to local content policies, and what other challenges do they face outside of the cost one that we've just discussed?
So these EU companies that we engaged with understand and appreciate the socioeconomic situation in South Africa and the need to develop, local capabilities and competitive industries as a mechanism to create jobs and ensure sustainable, broad-based economic growth. Most of the companies that we interviewed actually have operations in several countries, such as Brazil, where these local content requirements are also applied. So, this is not unique to South Africa. It's a process that they've had to adapt to as they invest in different countries. So overall, there is an appreciation of what the government is trying to achieve. But unfortunately, the lack of consistent and predictable demand, the unclear, regulatory space has weakened investor confidence, with some of the companies that we have engaged with a little bit hesitant to invest in new productive capacity, should policy certainty not be provided. So it's important, that government comes to the front and provides steady and, gives, companies some level of investment to, some level of confidence, to invest in the country.
Yeah, so another concern is the design and implementation of local content regulations. You've also spoken about that uncertainty that comes for investors sometimes when they believe that government isn't giving them enough clarity. Let's talk about the renewable sector in particular, because you focused on that in your report.
Yes, so the Renewable Energy Independent Power Producers Procurement Program, the REAP, was granted an exemption from government standard procurement processes. And here, the projects are evaluated on a 70-30 point system, where projects, are evaluated 70% on price and 30% on how they will contribute towards economic development. And within this 30%, it looks at 6 criteria, which 7 actually, which also include local content, job creation, and enterprise development, among others. While, the Renewable Energy Independent Power Producers Program is quite flexible and allows IPPs to assign local content requirements along the value chain, it makes it difficult for different parts of, the value chain to anticipate these local content requirements and plan for them. Additionally, the design of the policy seems to lack an appreciation of the industrial base that's available in South Africa. So these local content requirements then seem to be highly unattainable, in the short term. And unfortunately, the situation is made worse by the fact that, these local content expectations are being ramped up at a much higher pace than South Africa's industrial base is developing. So this leaves companies having to incur higher costs to navigate the high policy expectations. In short, it seems as though the policy design has fallen short in terms of considering the preconditions that are required for an effective localization policy, such as reliable and predictable demand, clarity and transparency of the rules, complementary industrial policies around skills development, as well as, just understanding what the lay of the land looks like in terms of available skills, technologies, and capacity.
Laurelyn, when you do a study like this and you get insight into people who are hiring around 1,000 people and who are contributing towards skills development and growth in South Africa, you'd almost want your study to go beyond theoretical or beyond being discussed on a television channel to people who make decisions when it comes to policy. Tell us about what kind of interactions you have with any of the decision makers with a survey like this.
So, we did have a media engagement a couple of weeks ago, and, the hope is that, government will catch wave of it. But, this obviously wasn't within the realm of the study. This is something, that the EU advocacy team has been engaging with. And on that front, they will obviously be able to share with you more insights as to how they're engaging with government. But from our study, it's important to recognize that policy custodians, and here, I will single out the National Treasury, the Department of Trade, Industry and Competition, as well as the Department of Energy to provide, policy certainty and send strong signals to the market. In other words, it's government that, it's important that government adheres to procurement strategies, even the Integrated Resource Plan, the IRP, which will provide certainty to foreign investors. Secondly, these local content rules need to be applied on sectors and products where there is strong and stable public demand. And this can include, consumables such as pumps and valves, or parts and components that can be reasonably and competitively manufactured in the country. And lastly, it's important that, like you said, that, government uses these evidence-based research studies in policy design and implementation to assess what's working and what's not working. And, as part of the process, open, honest, and constructive dialogue then becomes very important between the public and private sector.
Laurelyn Kaziboni, who's an economist at DNA Economics, thanks so much for your time on Economics Unbound this evening. So it's time for us to take a short break. When we come back, we'll be speaking to the Treasurer General of the Black Business Council on procurement issues and broad-based Black economic empowerment and more. Do stay with us on SABC News. Thanks for staying with us on Economics Unbound. Let's continue talking about local content requirements and broad-based Black economic empowerment. On Skype, I'm joined by the Treasurer General of the Black Business Council, Bonolo Ramokele. Thanks so much for your time on SABC News. Let's start with that recent Supreme Court of Appeal ruling on preferential procurement. What does it mean and what does it say about what you need to do as a company when it comes to Black economic empowerment?
Evening, Nzinga, and evening to the SABC viewers at home. When it comes to this, this judgment, obviously we were very concerned when we saw the outcome at the Supreme Court of Appeal, but we were not disturbed to the extent that we feel that this is going to have a gross impact on businesses, because we already knew that those regulations were not consistent were not constitutional, and what we want as the Black Business Council is that instead of dealing with the small issue of the regulation, let's rather deal with the Act in its entirety and bring about the Procurement Act so that the triple PFA is rendered obsolete. Because if you look at the judgment says nothing about the Act. So the Act is constitutional, but it was just the regulations that were not consistent with the law. So we're saying to overcome all of that, instead of focusing on the regulations, let's rather overhaul the Act and fast-track the process that has already started with the Public Procurement Bill and make it a Public Procurement Act that will deal decisively with the exclusion of black businesses in the mainstream economy.
Let's talk about that public procurement bill that you're hoping is going to move towards an act. What does it say? I mean, it's quite a difficult way to ask you to condense legislation into, a bite-sized chunk that our viewers can understand. But what does it say? What are the objectives? And what do you find good about it?
Just to explain it in a very simplistic manner. The government, when it provides services, it needs to use a procurement legislation. And since we have had in different manifestations the triple PFA, which has closed out black business people out of procurement opportunities. And so if you look at, for example, currently there is a big aspect, the big aspect of public procurement is centered around pricing, and the issue of empowerment and the triple BE does not come out strongly. If you were to explain it to people who are in business, currently if you evaluate government, 90% of what you look at would be pricing and the functionality, and then only 10% of a particular tender would be looking at whether the company is empowered. And for certain tenders, it will be the 80-20 principle. 10% of the pricing is looked at, and then 20% of the consideration is around whether a company is owned, is women-owned, is for people with disabilities. So what we are Public Procurement Act, what we are saying is let us designate a huge chunk of what is sitting as public procurement and make sure that the empowerment element comes out more strong and more announced, so that going, for example, I'll give an example in areas such as, for example, cleaning, security, catering, and so forth. Why can we not say that 90% of what is considered should be and 20% should be pricing? Because there are so many companies in that space, automatically are going to get competitive bids, but you are at least saying that all of those bids must actually be 100% black-owned, women-owned, youth-owned, and so forth. So this public procurement bill is going to do away with all of that those artificial hurdles and barriers that were keeping black people out of procurement opportunity in public terrain.
All right, let's talk about that survey that I was speaking to Laura Lynn earlier about, an EU survey of some of the challenges that European companies based here experience when doing business in South Africa. One of the issues that was raised is the local content requirement pushes up prices a little bit, and that also impacts the consumer. And there was also the challenge that companies responded by saying that the policy in South Africa is not certain, especially when it comes to broad-based black economic empowerment, procurement as well, and sometimes local content requirements are unobtainable.
I think that we need to be quite honest in our assessment of this particular survey. And we did have an engagement as a BBC with representatives of the union in the country earlier. We did expect with this because on a principled basis, when you look at it, it almost to attempt to undermine and reverse some of the gains that have made to empowerment and triple BE. And the reason why I say this is that if you look into the itself and you look at some of the recommendations that are coming out of it, is that it seems as if European companies are saying that we don't like doing empowerment actions whereby we bring in local partners because it's just too cumbersome, it's too complicated for us. And also, we don't want to do what the DTI, the Department of Trade and Industry, has put in place, which is called equity equivalence, whereby they put the amount of money in exchange as opposed to doing ownership transactions with locals. And even that, which was the government trying to meet and companies halfway, the EU companies are saying that even that is too cumbersome, it's complicated, they can't do it. But now when you look at the recommendations of it, they're centered around that rather European Union entities focus a whole lot more on skills development and programs such as the youth employment service, so that they can be able to replace, the ownership and control elements of VEE. So overall, on a principle basis, we think it's fundamentally flawed, and may start reversing some of the gains that have been made by the country when it comes to an empowerment project that is not doing well as we speak. So we do think that rather they needs to be utilized to say, how do we within the and also within the current legislative framework to make sure that we balance out companies coming into the country whilst not sacrificing BE and also sacrifice empowerment. We need to get investment. The two are not, we cannot separate the two. You need to have investment, but you also do need to have empowerment, true empowerment of South Africans in a broad-based manner.
Treasurer General of the Black Business Council, Bonolo Ramukele, thanks so much for your time and insight on SABC News this evening. And apologies to our viewers, but sometimes the break in transmission there does happen when we are on live television and using, of course, Zoom and Skype and all of that. So the coronavirus pandemic has stalled the implementation of some of the investment commitments South Africa received at its last two investment conferences. Addressing this year's conference in Johannesburg, President Cyril Ramaphosa said 21 projects representing about 10% of investment pledges have been delayed or put on hold because of the coronavirus pandemic. He announced that 57% of the total investment commitments are under construction, while 19 investment projects have already been completed. The progress made is said to be testament to the resilience and the potential investors see in the economy. The sector that has seen the greatest flow of investments is the mining sector and mineral beneficiation. It's followed by investment into the ICT and automotive sectors. The Africa Free Trade Area holds more opportunities for turning around the local economy.
We will be able to work together as we build our African Free Trade Area market to interface and also to deal with the biggest economy in the world. This could not have come at a more welcome time. So I see prosperity written all over our country. I see us being able to embrace one another, to hold each other's hands as we move forward and deal with the challenges that stand in our way and overcome those challenges. Unfortunately, we've got a great deal of partners on our continent, and we've got a great deal of other partners across the world. Let's move forward and implement our plan and make South Africa a successful and a prosperous nation.
We've seen a unique level of collaboration, particularly in the context of the pandemic. Social partners in the form of government, labor, community, and business came together rapidly and effectively to see how we could deal with the challenges, how we could reorientate the economy, and most importantly, as the President has mentioned, how at the same time we could start to plan the reconstruction and recovery plan that we all rely upon. Because it is only if we can demonstrate that actually our actions are louder and more effective than our words that we're going to be able to instill the requisite confidence. The last two investment conferences were extremely successful in mobilizing investment, and of course we shouldn't be surprised that the level of commitment has stalled as a consequence of the pandemic, but we've used that time wisely and efficiently as partners because, as the President again has said, we have listened to one another to ensure that we can identify those areas of the economy that need to be focused on, the need for a ruthless focus on implementation, and in particular harnessing the resources of all social partners so that we can not just mobilize capital domestically and internationally, but equally that we can bring to bear the skills, experience, and competence that exists to shore up existing capabilities.
Economist Mike Schuessler says commitments made by the state have not come to fruition. He says South Africa has one of the lowest investment rates as a percentage of GDP.
But we must remember that all the commitments that we had in the past haven't come to fruition yet. So it's easy saying things and it's much more difficult pulling it through. And I think the presidency has realized that, and he also did warn of that. It is, however, a very big change in that we're welcoming investments. Quite frankly, I think that's something that we should have always done. But we seem to have scared away a lot of investment. And if we look at our current fixed investment from both the state and the private sector, it's looking very dismal. South Africa, as such, has got one of the lowest investment rates as a percentage of GDP. But moreover, I think the big thing is that our combined public sector investments are at about a 12-year low. So it's easy for the state to say other people must come and invest here, but their own proof in the pudding is not here. And I think that is one of the aspects that is making it more difficult to attract investment.
Right, now I'm joined by the Head of Trade and the Economic Section, the delegation of the European Union to South Africa, Mr. Robert Sisuchi. Thank you so much for your time on SABC News this evening. So talk to us about that study commissioned on behalf of EU investors in South Africa around broad-based black economic empowerment.
Yeah, thank you, Nzinga, and good evening to you and to all those seeing us. The study actually is the outcome of a feeling that we have as European Union of wanting to contribute to the transformation in this country. European Union, as you said at the very beginning of this program, is the #1 investor and it's the #1 trading partner of South Africa. And politically is also a strategic partner. So we have really regular presidential summits and meetings. But with responsibilities comes also obligations. And one of these obligations is, of course, to ensure that there is a continued flow of investment in the country, but that also generates economic transformation. And I wanted to say that from the outset, because in order to make clear that European companies and European Union is committed to economic transformation in South Africa. You cannot operate in this country without overcoming the legacy of the past and empowering all people of this country. We are all very much aware of this, and our companies as well. And it is for this reason that we had actually commissioned a number of studies when it comes to different investment-related issues. And Lauraline before was dealing with the local content aspect. And I'm now going to say something on the black economic empowerment. But again, the purpose of these studies was to discuss without taboo what is the situation on the ground. And here, I think we share a common understanding with the stakeholders in South Africa, including BBC, the friends from BBC that we met this morning, including the friends from BUSA, from BLSA, and from BMF, that actually the flow of investments here are not what they should be. And also the economic transformation is not what it should be. We haven't achieved economic transformation in full. We have done something, but not in full. And for this reason, we have commissioned the study on black economic empowerment a bit to understand a bit what is the situation. What was interesting from the study, and actually also from a database, the Who Owns Whom. This is quite a reputable and reliable database that shows the situation of companies in South Africa. We have seen actually that out of all companies, EU companies registered in South Africa, 27% have a level of compliance between 1 to 4. with the Black economic empowerment. So more than 1/4 of EU companies have a level of compliance from 1 to 4, which is the top level. 22% actually have a level of compliance from 5 to 8. And also, when it comes to the different targets under the different indicators of the BBBEE policy, I saw, and I was very surprised by the positive scores, because, for instance, 88% of the targets were met for the socio-economic development, 74% were met for the enterprise and supplier development, and 65% were met for skill development. So that are data, are facts, and are figures, undisputable based on the data collected by this database. Now, what came out clearly from this study was that European companies were not only committed to Black economic transformation and empowerment, but they were also embracing the policy. It was not just a box-ticking exercise. It was something that they wanted to allocate the needed resources in order to see. What also came out as a key conclusion of this survey was it is a cost, quite a costly exercise. This is undisputable. Companies need an accountant and needs to pay the verificators in order to comply that policy, but that is done. But in any event, it remains a costly exercise that somebody has to capture in the business model of a country. And it also came out that there has been some changes over time over the codes of good practices and of the basic acts, and it was sometimes difficult to follow up all these changes, but they managed to follow these changes. Now, the key issue that came out was relating, as our friends from the Black Business Council were saying, was related to the ownership requirement. But again, the conclusion was not to exclude the ownership requirement at all. It was what the survey indicated that SMEs, so family-owned companies in Europe, and SMEs are the backbone of the economy in Europe and in South Africa, and they have a lot of specific technologies, specifically now for climate change, for green revolution, green recovery. And so a family-owned company is reluctant to give away ownership, and it is willing to partner. It is willing to contribute to skill development, is willing to contribute to socio-economic development and to supply and enterprise development, but ownership is much more difficult to comply. So some SMEs in Europe are reluctant to invest in South Africa because of this, but those present in South Africa are willing to go ahead in this way. But given this situation and given the fact that we could have much more SMEs coming into South Africa and to invest and to contribute to the many economic empowerment elements of the country, we were just wondering whether there was a way to tackle this ownership part without excluding it. We are not claiming or arguing that Black ownership should be excluded. We were just thinking either in terms of recalibration, seeing whether there was a way to giving more points to all other elements of the scorecard of the BBBEE policy, or see how the equity equivalent program of DTI and the Youth Initiative could be made more accessible, because the way they are structured now, they are not accessible easily to companies. And I'm happy to elaborate on that, but I would stop here at this stage.
Okay, Roberto, can you just explain to us, perhaps, and I think you've gone through all the issues that I wanted to talk about when it comes to the survey, the issue of costs, the issue of ownership. I know one of those surveys compared how Namibia and Malaysia implemented broad-based Black economic empowerment or empowerment to redress policies from the past. So perhaps this isn't directly a financial economic question, but I wanted to find out, as the EU, how do you balance the need to get insight, make suggestions as you're doing, work with a lot of partners in here and share those recommendations without being seen as trying to either dictate to a country or a government on how to handle inequality and how to handle our past, particularly in light of the history of European and African relations?
Well, I can tell you that, first of all, our engagement is very genuine and open and transparent. We are very keen to engage with all stakeholders, the public sector and the private sector here in South Africa. And because we believe that actually there is a stumbling block somewhere, and it needs to be solved. It needs to be solved to the benefit of all parties, South African and European Union. And the genuine and candid spirit with which we want to engage is exactly to see which are the stumbling blocks and how we can overcome them. So we certainly don't have any lessons to teach to people, and even less to South Africa. South Africa has excellent capacities and minds and brains, and I'm always flabbergasted by the vibrant debate that there is in South Africa around these issues. So we are not here in order to teach lessons. We are here actually to be not part of a problem, to be part of the solution. We need to understand it is a fact that economic transformation has not been achieved. It is a fact that investment flows are not what they could be. How are we going to solve this? And it is exactly with this spirit, without giving lessons, without recommendations, that we want to engage to see how we can move forward.
The head of Trade and Economic Section Delegation of the European Union to South Africa, Mr. Roberto Sestuti, joining me via Zoom there. Thank you so much for your time and insight into these studies and the work that the European Union does when it comes to South African business and investing. It's time for a short break. I'll be back with more. So staying with the South African economy, global rating agencies Fitch and Moody's have both downgraded South Africa's sovereign credit rating further into junk. Both agencies cited that a downgrade was due to a combination of South Africa's weakening fiscal position, rising government debt, and the economic shock due to the COVID-19 pandemic. Meanwhile, S&P kept its rating outlook at stable.
Two of the three global rating agencies, Fitch and Moody's, downgraded South Africa's sovereign credit rating deeper into junk status. The two agencies have raised concerns about the country's weakening fiscal position, rising government debt, and the economic impact of the COVID-19 pandemic. However, Moody's said that while South Africa is not alone in having been severely affected by the crisis, its capacity to mitigate the shock over the medium term is lower than most of its peers. They also expect GDP in 2022 to remain below the 2019 levels. Analysts say the continued downgrade may see South Africa lose its appeal among investors.
Due to the negative investor sentiment, there seems to be sort of a negative effect to foreign direct investment flows of countries that have recently been downgraded. It obviously does turn around over the medium term, but the thing is that the continuous downgrade, so if it's a continuous process, then that obviously adds to the negative investor sentiment, and it obviously deters investors from investing into South Africa.
Meanwhile, one of the global rating agencies, S&P, has kept its long-term foreign currency rating to a stable outlook. S&P said that while the strict lockdowns had plunged South Africa into its sharpest quarterly economic contraction in the second quarter of the year, it expects growth to improve going into 2021. Economists say the downgrade does not come as a shock.
Not as a surprise. Most economists expected them to downgrade, if not now, then later on certainly. And I don't think this is the last surprise. And it's not only for the economists that didn't come as a surprise. The financial markets also were not surprised. The financial markets hardly reacted to this. The rand is pretty stable, the capital market is pretty stable, and the current movements on the capital market and on the rand has mostly got to do with international factors. So no surprise at all.
Government says the recent rating outcomes indicate that South Africa needs to fast-track growth-enhancing strategies in order to rectify the accumulation of debt that currently stands at nearly 4 trillion rands. Responding to the downgrade in a statement, National Treasury says government is committed to fast-track the implementation of critical reforms aimed to raise economic growth and improve fiscal sustainability. Nothando Makutulela, SABC News, Johannesburg.
Thanks so much for being with us on Economics Unbound. That's where we leave it this evening. Thandeka Gqubule Mbeki will be back with you next week. Goodbye.